Hello, welcome everybody. Thanks for being here today. We are welcoming back Rightside Capital Management. We are super happy to have them here again. It's a fascinating opportunity and structure to invest in pre-VC stage companies. And of note, and I think it's super important to note this, that this isn't at all an emerging manager. This is a 14-year history of doing this successfully. So Jeff and I have got to know each other pretty well because we've done several of these for the Family Office Insights community, and several people have stepped up. And Curt has participated last time and here again today. So as a reminder, we can't hear or see you, but we know you're there. And if you would like to ask a question, please be sure to put it in the chat box or the Q&A. We have a lot of people coming on today, and we'll get to as many as possible. And the ones we don't get to, we'll be sure to answer post-webinar. Also, if after seeing the webinar today, there are others that might be interested in connecting with Rightside, you're certainly most welcome to do that, and we'll make it easy for you to make that happen. We're also going to be recording this, and if it's okay with Rightside, we'll be posting it to either their website or the Family Office Insights channel, or both. And so you can revisit it as needed or share it with others. So with that, thank you all for joining us today. And we're going to start out with Curt. Curt, take it away.
Thank you, Arthur, for that kind introduction. Thank you all for joining us. And as Arthur mentioned, I'm joined today by Rightside co-founder Jeff Pomeranz. Before we start, I was asked to read a brief disclaimer. So the information in this presentation today is for informational purposes only. It's for accredited investors only, and is not an offer to buy or sell securities. Nothing contained herein should be interpreted as investment, legal, accounting, or tax advice, and past performance is not indicative of future results. So with that out of the way, we've got a lot of ground to cover, so let's get started. As Arthur mentioned, Rightside was formed 14 years ago, originally as an idea by Jeff and his two co-founders, around this notion that there's a better way to invest in venture capital, or more specifically, there's an area of venture capital that's completely misunderstood and underutilized. And we'll talk in great detail about that. It's this area we call pre-VC stage investment. But along the way, since our first fund launched in 2012, we have invested in over 2,000 early stage tech companies across our now 6 funds. And we are currently raising Fund 6 with an expected final close at the end of this year, or in possibly the first quarter of next year. We're going to dive into a lot of detail about what we do and how we do it. But first, we thought it might make sense to kind of give a 30,000-foot view of the venture capital investment ecosystem. So on the kind of from left to right, you've got increasingly large rounds of capital that get invested as companies progress down their path towards, I guess, what many companies hope is eventually an IPO. And the venture capital industry really sprung up around what's now called Series A, which is no longer the first opportunity to invest. But over the last couple of decades, due in no small part to these capital efficiency trends, venture capitalists have invested earlier and earlier. That gave rise to the seed round, and more recently, the pre-seed round. And so today, there are venture capital funds that invest solely or even, or at least partly, in pre-seed rounds. And I'll start by setting that table a little bit. So a pre-seed round is small in size. It's maybe $1 million or $2 million. It's at a valuation of $5 to $10 million. And it's occupied, or it's that space is frequented by a combination of venture capital firms, angel investors, friends and family, founders' checkbooks, et cetera. And so what Jeff and his partners started thinking about back in 2010 was what happens before pre-seed. And there's been, as the capital efficiency trend has continued, there are increasing opportunities to invest what we call ahead of the VC herd. And we'll talk a lot about why typical VCs won't go earlier than pre-seed, or why it's impossible for them. But this is where we live. And we have, you could call this very early stage technology investing. We tend to call it pre-VC because we're getting in ahead of the VC curve. And one of a few of the hallmarks about this area of investing, it generally tends to be higher risk and higher return. We care a lot about this space. We focus on this space because we believe that it has the highest reward to risk ratio, or risk-adjusted return potential, in the entire value chain. So as I said, back when the company was being formed, we saw this opportunity. We saw this phenomena where when deal sizes are too small, venture capital firms check out. And yet these are the best risk-adjusted returns. So why is that? What's the problem? What's the challenge? What is it that we had to figure out? And the challenge is really twofold. One is, it's not easy to invest in lots and lots of very small rounds. So a typical venture firm, maybe $100 million, $50 million. You can't really invest at valuations or in round sizes below $1 million without being ultra diversified. We'll talk later about why most VCs don't do that. But it was very difficult for them. And the second is that without proper diversification, it's very risky. So as you get earlier and earlier into a company's life cycle, you have less proof of concept, and it's a riskier on a single company basis. So it requires significant diversification. That's something a typical venture capital firm doesn't want to do. So our solution has been, we set about to create a platform, or an investment platform, or funds that invest ahead of the herd at significantly lower valuations in capital efficient companies, and then massively diversify. And so I guess the question is, does it work? And we're happy to say, now that we're in Fund 6, that all of our first 5 funds have produced returns that are in the top quartile of their VC peer group, as measured by Cambridge. All right, so a big theme of what we're hoping to convey to you all today is that we're very different. We're very different than most or any VC you've ever met. So a typical VC sets out to create a concentrated portfolio, order of magnitude 15 to 25 companies. We set out to create ultra diversified portfolios of 500 to 600 companies. The next piece is really important. So if you think about what a venture capitalist does, why does a venture capitalist exist? It's to find winners, right? It's to identify within, let's just pick a vertical like healthcare. And if you're looking at healthcare B2B SaaS, you're going to put together a team of experts in that field on your investment team, and you're going to try to pick the winners in that category. It's our belief, proven out by data, that that's extremely difficult to do. Essentially, what you're trying to do at a very early stage is differentiate between the amazing and the ridiculous. And it's possible, but if you look at venture capital firms' returns, even the best and most well-known, they tend to be up and down. They tend to be, cyclical is not the right word, but they have good funds and they have bad funds. They have good years and they have bad years. What we're doing instead of trying to pick a category winner is we have identified a series of characteristics that make great companies, that make great venture level companies. And we're going to talk in great detail about that. But what we're trying to do is build a diversified portfolio of companies that exhibit winning characteristics. The typical VC will sell them as best, as we've mentioned already, in a sub-$1 million round. And yet that's where we live. So we're living in an area that the typical VC ignores, which is a big part of we think, our success. So what does a typical what we call pre-VC company look like? You might think it's an idea or it's something on the back of a cocktail napkin, but that's simply not the case. It's a capital efficient tech company. That's very important to us, and Jeff will talk a lot about that in a minute. But it has a live product in the hands of customers. It has proof of concept. In fact, today in our newest funds, it's almost the case that all of our companies have monthly recurring revenue, proof of concept in the hands of customers, something that we can analyze and identify and verify. And the range is 5 to 30 with a mean of around 15K a month. So we're not investing in concepts. We're not investing in ideas. We're not investing in the back of a cocktail napkin. We're investing in real companies with real customers and real revenue. We're investing in round sizes of between 100 and 500,000. Very important to our strategy. And at valuations between 1 to 4 million and certainly below 5 million. And again, Jeff will dive down on that, drill down on that a little bit later.
I know you guys are going to cover this, but one of the reasons I think that, aside from all the points that you made, that VCs are not interested in this stage of companies is the logistics of investing in 600 companies. So I just wanted to mention that that's one of the pushbacks, right? But you're going to talk a little bit later, I think, about how you do that.
Yeah, I'll high level it, and then Jeff, I think we'll take a much deeper look at that. But at a high level, you're exactly right, Arthur. It's very labor intensive. So if you think about what a typical VC does, they have a team of experts. They've got principals, partners, associates, and they try to drill very deep. They might spend 6 or 9 months in due diligence on a company. Once they make a decision to invest, they take a board seat. They reserve additional capital for follow-on offerings. And all of this adds up to being very labor and capital intensive for the VC firm. And this is really why they invest. They stay away from this sector. So that model breaks down below $1 million, and it's completely untenable below $500,000. And so what that's created for us is our opportunity. So this is, in some ways, it's a kind of a good old-fashioned Wall Street arbitrage, right? We've identified a market that's inefficiently priced. It's inefficiently priced because at the level we invest, you have little or no professional institutional venture capital competition. We're competing typically with angels, friends and family, some accelerators and incubators, and frankly, founders' checkbooks. And as Jeff will discuss later, that gives us this tremendous competitive edge in this space, while at the same time, it keeps valuations at the entry price low. So there's a pretty big gap between pre-VC and seed round or pre-seed when venture capitalists get invested in valuation. And that's what we're capitalizing on. With that, Jeff, I'll turn it over to you to take a kind of a closer look at what we do, how we do it, and how it has worked for our investors.
Great, thanks, Curt. I'm going to just get my screen up here. Okay.
Looks good now.
Thank you. And thanks, Arthur, for setting this whole thing up. Thanks, everyone, for joining. So as Curt described a bit, we are taking advantage of this multi-decade-long capital efficiency trend within the whole tech ecosystem that has, over time, given birth to what we call seed stage venture, which, that term did not exist 15 years ago, and it gave birth to pre-seed venture, which again is a term that didn't exist 10 years ago. And we are an extension of that same trend, because it ultimately, this whole trend, when we're talking about capital efficiency within tech, it's all about tech companies being able to build product with less capital and less time every year. So that gave the ability for venture firms to simply invest smaller amounts of capital into companies because they could make so much more progress so quickly with less capital. So we're an extension of that. And like Curt described, the problem is at a certain point, that venture model simply can't adapt to such tiny amounts of capital, because we are addressing companies that really only are looking for less than $500,000. And that simply is too little an amount of money for venture firms to address. Even when they love the company and love what those founders are doing, they will simply wait until that company is looking for larger rounds. So what we and then what we've done is we wanted to, like Curt described, we build massively diversified portfolios. Now that necessitated a very different way of how to invest. And ultimately to another way to describe what Curt was explaining on, investing in companies with certain characteristics, if you combine all those characteristics, we look at it like they are profiles of companies. And when we invest in a company, we're not saying we believe this particular company is going to be the winner in that vertical or category or whatever. We're saying if we invest in 50 companies or 100 companies with this kind of a profile, with this quality of a founding team, this kind of a business model, this much revenue already, and we can get that company at X valuation, well, we know that pool of 50 companies will crush the returns of the market. So we're systematic investors in large numbers of companies. And that necessitated a different way of approaching it that can invest in a much more speedy fashion. So we developed a data-driven investment process. We're using the objective data that exists on a company at that moment in time to inform us of better types of companies, better pools of companies to invest in. And then we invest in large numbers of those companies. Now, one of the other outcomes of that is we needed to do this so that we could make fast decisions and invest in large numbers of companies, but take it from the perspective of the founders now, the entrepreneurs. It's actually exactly what they're looking for too, because they're going to get a yes or no from us in usually several days or a week, and they might have capital in their hands within several weeks, assuming they have been able to get us all of the data we need to validate and vet their company. That is as opposed to usually at least a 3 to 6 month kind of strenuous fundraising process, and much worse today, that entrepreneurs have to deal with. So in essence, we're giving them something that they can't get in the market. And it's another reason why founders are more accepting of even lower valuations. The end result of all of this is we now can have massively diversified portfolios, all within this high-performing segment of the market, and we're able to get into those companies at what we feel are highly discounted valuations. Now, when you roll all that up now, we can deliver a very compelling return profile. We can mitigate the risk, certainly, by through the massive diversification. We're sort of smoothing out the risk curve. And we can also now capture the high returns that exist at this end of the market with much greater confidence, with much greater repeatability, regardless of the macro environment, which always has a large effect on any of the returns in venture capital. But we can, again, help smooth that out. And what this chart is showing you is the historical net TVPI. TVPI is total value to paid in capital. It's another way of describing net multiple. And for each of our funds, the blue line is our oldest fund, Fund 1, yellow is Fund 2, et cetera. And it shows the historical, so you can look at Fund 3 at 6.5 years in and see how it compares to our Fund 1 or 2 at 6.5 years in. So I think it's a good visual. People can get a lot out of this. But one of the things is simply that all of the funds have a similar return profile. You don't have many big ups and downs. Again, it's through smoothing that risk curve and through the massive diversification, you get that kind of repeatability. Our first fund is obviously done extremely well. It's far exceeded our expectations. We have over a 7x total return in the fund so far, 6x of which has been distributed back to investors. And we'll get to some of those other details later as well. Our goal is to deliver 3 to 5x or greater net multiple to our investors in any of our funds. That equates to roughly 20%-ish IRR, give or take. And there also are a couple major tax breaks that exist to incent early investors like angel investors, founders, and we benefit from those rules as well. We'll touch on that later. But the bulk of the gains that we produce, over 90% of the gains we've distributed out of Fund 1, for instance, have been free from federal taxes because of that, and in most states. So again, we'll touch on the tax stuff later. So that was absolute performance. This chart is showing relative performance. So this is showing each of our first 4 funds, Fund 1 on the left, Fund 2, 3, 4. Fund 5 isn't on this because it's too young to have meaningful data against the benchmarks. The blue is the TVPI of our funds. The orange, reddish bar is the median return of the Cambridge US Venture Capital Index. Cambridge has the best compilation of venture fund data that exists out there, and they produce a quarterly index for that. So as you can see, all of our funds, and we're very proud of this, it's extremely rare in the venture industry for firms to produce top quartile performing funds through all of their funds. Now, I want to touch on a few things on this slide. This is showing our top 10 exits from our first 3 funds. And we have this here to highlight a couple points. We are investing in general at almost everything we do is at a $2 to $4 million-ish valuation, rarely above $3 or $4 million valuation, and almost never above 6. So our median valuation at entry point on our investments is only $2.5 million, extremely low valuations. And what that means on the exit side is we can produce, and also remember, these are on capital efficient tech companies, with tends to mean that we have a greater percentage of companies that need to raise less capital. So there's less dilution through a lot of this stuff. So we can produce extremely high multiples on our exits. That was my point here. We're going to steadily produce 50, 100, 300x plus multiples at the stage where, late stage venture, growth equity, private equity is actually just investing in companies, because we primarily are getting our liquidity by selling to those firms. And that's an important point. This is the secondary market, but they're the buyers, we're the sellers. We're selling at a $500 million to several billion-dollar valuation, and we're getting massive multiples there because of our entry point being so low. A second thing to point out here, so you see TradingView, DigitalOcean, these were companies, some of our biggest exits from Fund 1, that, these were, again, exits at the first time we sold into the secondary market of TradingView, it was at a, less than $700 million valuation. We sold the bulk of our remaining position at a $3 billion valuation. The buyers were late stage venture growth equity firms. So another thing to point out, and I'll highlight one company on here, the purple one there on the left, which is Cami. There's another aspect of what we can produce here that's important, in that we can produce very high exits and relatively low exit valuations. So Cami was a company that is our most recent exit, actually, from 2 months ago, is a company that we invested $97,000 into back in 2015, I believe. And a private equity firm bought the majority of the company, which is where we exited, at less than $200 million. So we're producing a 54x multiple at a sub $200 million valuation. And a sub $200 million valuations in general is not something the bulk of any of the venture world wants. That's not a successful exit to them, but we're producing extremely high multiples there. Another thing to point out, not to get too long-winded here on this, is companies like TradingView and Cami had zero venture capital firms associated with them. They're so capital efficient that they really never needed to tap the capital markets and venture capital. They became profitable. They could operate so efficiently. Obviously, they were successful, so they were growing quickly. They just never needed to tap those markets. And that's something that is getting increasingly frequent today, especially actually it's been accelerated by the AI being such an enabling technology across all tech. It's making companies even more capital efficient.
So is it a good time to talk about AI? And before you jump off that slide, and I don't want to go too far deep there, but wouldn't it also be true or fair to say that because you're selling into the secondary market, that the time frame to exit can be compressed, which otherwise...
Yeah, that's actually an interesting point you bring up. That is possible. That we are seeing more companies with the ability to grow more quickly because of AI. It's not, but that's not the most dramatic effect we're seeing across this stage of the market because of AI. It's not that it's shortening the life cycle to exit, although in some cases, yes. It's more about how it is affecting what companies can do with even less capital. So that means there's a bunch of outcomes of that, but one is there's, again, less dilution as they grow. So that's a positive for anyone that is invested. It means they can, in a lot of ways, we're seeing companies that might be able to get to billion-dollar plus, unicorn companies with even less than like 100 employees at their firm, because they can do so much with so little cap. They don't need as many employees, right? That means that there's a greater percentage of companies we're seeing that just never need to tap into the traditional providers of capital, again, venture capital, for these tech growth companies. So a little bit of a tangent to your question, but yes.
Is it also true, even though sort of the robust AI stuff has only been with us presumably in the last year and a half or so, that it allows startups to get to an MVP and customers sooner?
Yeah, that has definitely been a major effect. It is allowing companies to build initial versions of their product more quickly. We keep internally at our firm here, we keep being amazed by how far this capital efficiency trend keeps going, and how companies can, entrepreneurs can bootstrap themselves with no capital raised to an enterprise caliber product selling to, a B2B enterprise company. That simply that never happened 10 years ago. It was just not possible. And that's happening regularly today. So you're 100% correct, Arthur, that it's definitely enabling that.
Yeah, and I had one other thought, and we could skip it if it's not meaningful, but when you're selling into what you're calling a secondary market, when a company's buying the shares of the company, either on an exit, like the private equity example that you used, or just in the next round, are you selling to them at a discount and that's why they're going to scoop up your shares?
No, when you sell, when we sell a direct, when we sell a company directly to another company, it's like selling any asset. It's like an M&A process almost, right? It's the same kind of concept. We're bringing in a number of bidders, buyers that want this growth asset, and they're bidding for that asset. And the concept of discount or premium is really just a thought of, it's more a sense of either you're thinking of it as based upon their last, confirmed financing round. So in that sense, yes, it's on a relative basis that bidding process, depending on how much time has happened since the last round and what's happened in the markets and so forth, that could be at a higher or lower price than the last round, right? So in late stage venture capital, because valuations got hammered starting in 2022, yes, there are lots of companies that are raising rounds of capital today at a lower valuation than what they did in 2021, or they might be selling themselves today at a lower valuation than when they last raised capital. So you can think of that as a discount. But in general, the process, unlike when someone is buying a fund secondary, it's not done as what people think of as a discount to the, financials of that firm right there at that moment in time.
Yeah, got it. Thanks for that.
Sure. So let me move to the tax side of it, because that's always a big question. And it involves a couple tax rules that are often, many people are just unaware of altogether. So, and let me just preface this again. I'm only going to touch on the high level aspects of these two rules. The most important thing people should take away is that it's something that you can take advantage of if you're an angel investor, if you're an early investor like us, if you're a founder. And the most important thing is you should make sure you have a CPA that understands this stuff. And certainly, again, we're not providing tax advice here. We're just trying to explain a little bit about how some of these rules work. So the big one here is what's referred to as QSBS, which stands for Qualified Small Business Stock. Now, this is a rule. It's been around for a long time. It's gone through a revision some years ago, which made it a little more capable for people to take advantage of. But this is a rule that, should it be an event that qualifies, you can get up to $10 million or 10x your capital basis free from federal taxes. And 45 of 50 states conform to this same rule. California, where I live, does not, for instance, but 45 of 50 states do.
Is the availability of it dictated on the state of the investor or the state of the company?
Yeah, good question. It's wherever the investor pays taxes. It has nothing to do with where the company is. Now, the most important criteria for a company to qualify for this potential gain is, number one, the company has to be a U.S. company, can't be a foreign company. It has to be a C corporation, so no pass-through vehicles. You, as an investor, you have to invest in the company prior to being worth 50 million of tangible assets. There's that test. So you have to be an early investor, and you have to have held the company for 5 years as equity before the potential qualifying sale. And you have to have acquired the stock at original issuance, which means from a primary round the company is raising. You can't, I can't buy shares of stock from you, Arthur, on some company you own and just, grandfather into these tax rules. Okay. So the secondary acquisitions don't work. But then if there's if we, like with TradingView, for instance, on the first part of our sale, when we sold the initial portion of that, of our shares, we waited until it was the month after we had owned it for 5 years as equity. And then we sold part of our position so that we could have all of those gains pass through to our investors free from federal taxes. So they received that distribution free from tax. And now another nuance here is that as a fund investor, this means it's 10 million, it all passes through on the K1, and we provide the details anybody needs on the K1. So we track this stuff and we provide it for the investor, but it all flows through. So it's actually $10 million of gains per company in the fund, per investor in the fund. So it's not $10 million of total gains then trickled out through all the different investors. It's 10 million per investor per company. So it's a very large potential tax break. It's very impactful. The second one, which is even more stringent to qualify, has to do with losses, called Section 1244. This is because most startups fail, remember. It just means that this particular type of loss can qualify against ordinary income and ordinary gains instead of just being a capital loss. So you can use it to greater effect on your tax filing. So the combination of these things is extremely impactful. What this is showing here is all of the data from a $1 million limited partner from our first fund, from the K1s rolled up in aggregate, okay? So if you take that $1 million investor in this particular case, the paid in capital was $930,000 because we had a small exit actually in year 3, which offset one of the capital calls. So they actually only paid in $930,000. We've distributed out to that investor $5.7 million, which is a 6.15x multiple to paid in capital. And they've, in aggregate, actually had less than 0 federal taxes paid. So remarkably impactful on the taxes, because roughly more than 90% of the gains that we distributed qualified for this tax break. And but we still have all the losses to pass through, right? In Fund 1, a little more than 50% of the companies have failed and been wound down and been passed through as losses. So those other losses exceeded what remaining gains there were. So actually, we've sort of produced almost like a tax credit to use against other stuff. Now, again, that's on a federal basis, depending on where you live, what state. There could be some state taxes still, but 45 of 50 states conform to the same thing. Anybody interested in more of this, obviously, we're happy to provide more detail. So again, to sort of combine, summarize this stuff again, our funds are designed to produce a 3 to 5x net multiple, 20% IRR, regardless of the macro environment. We know today, for instance, we've got some of the best macro environment to be investing new capital into. So we know that it's impossible to really predict, 7-8 years from now, what kind of macro environment we're going to have, which is going to be important for when we're exiting these positions potentially. So our funds are designed, and by doing this in large volume the way we do, we can smooth that out and produce these kind of consistent returns regardless of that macro environment. That's our goal. So far, that's been the case across all of our funds. And then take advantage of these tax breaks so they're massively tax efficient. So
you've run through a few administrations having that experience too, so good for you, right?
Yes, yeah, we've been through a couple cycles. We've all been, our funds have been going for 12 years. We've been doing this across, into our 6th fund now. As partners, we didn't go through our backgrounds here, but myself and my 2 partners, we've all been in the tech world for 30 years or more each. We've been through a lot of cycles with this stuff. And we've all been owners, operators of businesses, sold businesses, et cetera. So I'll pause there for any. I think we'll turn it back over to you, Arthur, for Q&A. Anybody that has questions, and I know I can see a few have come in, but Arthur, I'll let you field that.
Yeah, sure. So you're in the business of raising funds for these funds and doing your work. Can we talk about the environment right now for deploying capital, like timing into venture? How you feel about that?
Yeah, so it's a great question. And I touched on it briefly a moment ago. The environment today, so it's been in the news quite a bit about how tech industry has been hit hard starting, it peaked in late 2021 and in early 2022, a little bit of the bubble popped. And it's an odd market because, the big tech companies, their actual the stocks are at all-time highs for a lot of these companies, but the actual tech industry has gone through a bit of a recession and laying off workers, for instance, and there's been a retrenchment there. That has trickled down to the venture community as well. It is easily today, and over the past couple of years, it is the most challenging environment, the worst environment for tech companies across all stages to raise capital. The number of financing rounds has plummeted. The amount of capital that is getting deployed has plummeted. It has stabilized. It is starting to move back up, but it's been clobbered over the past couple of years. So that has been extremely disruptive to the entire industry. For all of those reasons, though, those sound like negatives, but if you're deploying new capital, it's a big positive. Now, one of the reasons it's a big positive is fairly obvious, because if you're the one investing capital in a bad market, well, you get lower prices. That's just like anything. If you're the one buying real estate, no one's buying, same thing. But the other reasons aren't quite as obvious. When I talk about tech industry being disrupted, tech being in a little bit of a recession, well, think of it from a startup's perspective. Startups are always trying to hire new workers, hire new engineers, and those engineers are now more accessible, easier to hire at cheaper prices. Operating costs have come down for startups. So from an operating environment, this has always historically been the case. Any kind of recessionary environment or post-recessionary years are always the best vintage years for venture capital to be investing capital into venture capital. And another aspect to remember in venture capital is all venture capital thrives off of any form of disruption. Disruption, yes, might hurt lots of companies. It might hurt lots of industries. And actually, I'll give you one great example. Look at the healthcare pandemic. I mean, obviously, it was terrible. It and hammered a lot of industries. If you're in the restaurant industry, it was brutal. We have lots of companies that lost 90 to 100% of their revenue seemingly overnight because of what happened. And so did lots of other people, obviously. So that is true. It leads to higher failures. More companies go under, but it also shakes up the whole ecosystem and creates opportunity. And when you're a startup, when you're young, you can pivot, you can adapt, you can change, and you can attack competitors more easily. You can take advantage of opportunities. The example I gave earlier on the exit slide, that company Cami, coincidentally, is a great example of one of those companies. It happens to be in a segment of the world that benefited from what happened in the COVID world, because they happen to have these little tools and products that every remote teacher in the world all of a sudden wanted. They have tools that teachers use to help teach remotely. And all of a sudden, everybody needed them. So their revenue went from like 3 million to 30 million in revenue in less than 9 months. So shocking growth. Well, what happens is that value creation that was in our second fund, the value creation there is massive. And it makes up for whatever other losers there might have been in our second fund, was more than made up for by that one company that simply benefited from some disruption. So anyway, a little long-winded to your question, but it's a good one, because this environment today, we know today is a great environment to be investing new capital. The last couple of years have been too. Next year, probably, we don't see things turning around rapidly. So this is a great environment to be investing into, yes.
Well, a lot of people hear about the large VCs that have endless amounts of institutional capital deployed to them and claim to have, burgeoning balance sheets. But they're just not investing in this stuff, right?
Well, correct. There's two things going on there. One, it doesn't matter how much capital they have or are able to access, they're not structured and designed or desirous of investing into companies that are only looking for $200,000, $300,000, $500,000. They're simply not addressing this end of the market. And they're even addressing their end of the market, whether that be seed, early stage, mid stage, series A, B, whatever. They're doing that in much lower amounts as well, because their first priority is just backing their own companies that are in their own portfolio. So that's part of their follow-on investing, supporting the companies they have.
Yeah. And they're also not at all considering the impact of the tax stuff that you guys incorporated in this.
Well, yeah, I mean, some are certainly, but and later stage venture, they can't take advantage of it because they're investing too late into the companies. But it is interesting that many, even early stage venture firms, we see strangely they're not really paying attention to the tax rules. Partly, I think, because even though their first check that they invest in a company, it might qualify, but maybe their follow-on checks don't. So it just doesn't have as dramatic an effect on the overall returns versus what we do, where all of our capital is deployed into the space, which could benefit.
Yeah, I have a couple more questions about that, but let's take a question here.
Sure.
What's the minimum buy-in and what is the expected time to liquidation for an LP, let's say?
Yeah. So, okay. So our funds, minimum commitment is 250,000. The fund is already live. This fund 6, we launched it in January. So anybody investing today to catch up on the capital calls, they would have to invest 45% of whatever they're going to commit. Balance would be called over the next roughly 18 months. Now you're asking about the time to getting capital back, distribution. So these are, we've talked a lot about, okay, all the benefits, high returns, hardly any taxes. These are wonderful things, obviously. What people are giving up by getting into this category, like all venture, it's illiquid and it's back end weighted and takes a while to play out. So the rough time frame would be, for somebody coming into our fund today, it's going to be 6-7 years from now, realistically, before they have received back in aggregate maybe 1x their invested capital. So it is back end weighted. The bulk of the distributions are coming out in years 8, 9, 10 or so of the fund. That's where the bulk of all the distributions happen. It's because there's a number of reasons. One is simply because there's so much value creation with those companies. You get this compounding effect that gets exponential in those later years. And there's also, remember, we have such a big tax break by waiting 5 years from our investment. We invest the capital over 3 years. It's going to be 8 years into the fund before we've reached that with all of our companies anyway.
Everybody's situation is different, but I'd happily wait 5 years not to pay tax on my $930 million investment that turned into 5 point something, right?
Yeah, we can all wish.
So actively raising now for the fund, 250,000 minimum, 45% of that is immediately called, more or less, I guess you call it that, and then draw down subsequently. What's hurry up, invest, right? So you're going to close out soon?
Yeah, we're hoping to finalize fundraising by the end of the year. So call it 3 more months. There's a chance we might just keep it open into Q1 if things go more slowly. But in the next 3 to 6 months, we'll have a final close. Yes.
What was it, 2015 to 2023? So that's like 8 years. on your example, the 930 and the 5 point something. I mean, and then
Oh,
on top, I think of it in terms of annual rate of return, which equates to about 20, right?
well, for that you're so yeah, you're providing the numbers for our first fund.
Right.
So based on the cash flows of our first fund, yes, I'll even go back to it here. Yeah. So we distributed 5.7 million. When you roll the cash flows, it actually that equates to a 27% IRR.
Yeah, because you have to
So
consider the return of capital, right?
correct. So
Yeah.
it's IRR is going to take into effect timing of capital calls going into the fund, as well as when the dollars came out of the fund, right? So it's a 27% IRR without any tax is what that equates to.
Yeah.
Now, but yes, in this case, we were in year 8 of the fund when when people got to a point of investors got to a point of being at over 1 to 1.5x distributed. And it was year 10 of the fund when it was, over 6x. So it was last couple of years is where the bulk of the capital came out. So there's still, you saw on the chart where it's, we have this big spike in the fund and then it sort of flattens out. We still have 1.5x left in the fund, which we're going to be winding down actually in the coming months. And then we'll distribute that last bit out to everybody.
Yeah, and you never know what's going to happen to the remaining companies in the fund, right?
That's
you
true.
get a bump on those.
Yep.
So what's the size of this round?
So our fund?
Yes.
So we have 35 million committed to the fund today. And we're looking at, we feel it'll be somewhere between maybe 75 to 100 by the time we wrap it up.
Yeah. Also, I think what's really interesting is in all the funds, how much money have you raised?
So of raised capital, roughly 200 million or so.
Yeah, it's a lot. Yeah. We got to wrap things up, but I could you just comment, because I'm fascinated by it and also impressed, the methodology in which you are able to act quickly and your tech that you guys built out to make sure that you're not wasting times with companies that, for example, just don't qualify on the basis of their structure, right?
Yeah, so that's a big question. So for the sake of time, I'll touch on it briefly. But yeah, obviously anybody that wants to get more information, wants to chat more, wants us to email the deck or whatever, email either Curt or myself, or call us. We're happy to send whatever details you want. But what you're getting to is what essentially, how can we do what we do? I referenced that we have built systems and processes. We have built a tech stack, if you will, that allows us to do these things. So we have thousands of companies that come in the front end. Think of it as the front end of the funnel. And idealistically, we want to have as big a front end of the funnel as possible. We want to see any and every company. What you need to have is systems, filters, if you will, that can cut through that huge amount of data. It's like a big data problem today. I mean, 15 years ago, the issue was, how are you going to find these companies? How are you going to access these companies? How are they going to find you? That is not the issue today. Any founder doing their job can go onto Crunchbase and AngelList and PitchBook and Carta and all of these free services, and they can find any investor anywhere, any VC, and their phone numbers are that's all there. So the issue is, how do you get through that noise? How do you cut through the data? So we have built tools and systems that allow us to filter through the 95%, get rid of 95% before we really have to spend any time with those companies. That's what's critical. You have to cut through it as fast as possible so that when you do have to spend some time, it's on a much smaller number of companies.
Yeah.
That's a way to summarize a little bit of how we're approaching it.
Yeah. And no small thing, even though you've probably benefited from the compression of time and cost associated with building a tech stack and AI as well.
Well, correct. You make a good point. I mean, we could not have built what we built all of this from the ground up starting in 2010. We could not have done this 10 years prior. It was impossible. It would have taken huge sums of money for us to build these tools. But again, we can take advantage of the capital efficiency trend too. We are looking at tools that use AI to even speed up the process even more. So we are beneficiaries of the same trend that our companies we invest in are taking advantage of.
Yeah, totally makes sense. Well, we appreciate you participating, and of course, it's our business to bring these types of opportunities to the Family Office Insights investor community, and I know directly from people who have participated in these with you prior that appreciation extends. It continues to be appreciated. So I thank you for doing this, and
Yeah.
look forward to doing it again sometime soon, I hope. And we'll make sure everybody can get in touch with you directly and see where that ends up. And Curt, thank you. That was awesome as well. Really appreciate it. Jeff, always a pleasure.
Thank you, Arthur, and thank you everybody for joining.
Yeah. And
Thanks, everyone.
thank you everybody for spending the only thing you can't make more of, and that's your time. Till next time. Thanks, guys.
Bye-bye.
Bye.